Welcome back to the Deep Talk. Today we are staring down the barrel of a fascinating and, frankly, a somewhat terrifying situation for a specific corner of the software market. It is Saturday, January 31st, 2026. The markets are finally closed, the dust is settling, and the silence it's loud.
Yeah, it is.
If you are holding shares of Elastic NV, that's ticker symbol ESTC, you are probably feeling a little bit bruised right now.
Bruised might be putting it mildly. If you look at the portfolio damage, it's more like a concussion.
Right. Maybe bruised is too polite. You might be feeling like you just went 12 rounds with a heavyweight.
Yeah, exactly.
The stock is sitting at $65.93. It is down nearly 39% in the last year. It's hovering right near its 52-week low.
And the last couple of days were just brutal.
If you look at the charts from just the last 72 hours, Thursday and Friday specifically, it looks like a cliff edge.
Just a straight drop.
It really is.
It's a classic capitulation chart. It's ugly. You look at it and your instinct is to, look away. It's the kind of chart that makes you want to close your brokerage app and go for a very long walk.
But, and this is the big but that we are here to explore today, we have this deep value research report in front of us. And it's asking a very provocative question.
It is.
Is this a falling knife that you should run away from before you lose a finger? Or is this a deep value opportunity, a rare chance to buy a high-quality asset at a 35% discount to what it's actually worth?
That is the question. Because usually when a stock drops this hard, this fast, there's something fundamentally broken inside the company.
Right. The product's a dud, the CEO quit.
Or the books are cooked. Something is terribly wrong. But when you peel back the layers here, which is exactly what we're going to do, you start to see a disconnect.
A disconnect.
You see a panic that is driven by macro fears, by things happening outside the company, while the internal machinery of the business is actually, humming along quite nicely.
Exactly. We're dealing with concepts like multiple compression, panic over tariffs, and a market that seems to have completely washed its hands of this stock.
So our mission today is to look past the noise of the last 3 days. We want to understand the actual mechanics of Elastic. Because I think most people hear search and they just think Google. But this isn't Google, is it?
Oh, not at all. Not even in the same universe. If Google is the front page of the internet, Elastic is the index of the deep enterprise. It's the search engine that runs the company, not the web.
The brain of corporate AI, as the report puts it.
It might just be.
So we have a lot to cover. We need to understand the tech, the money, the panic, and the opportunity. Let's get into it.
Chapters 1 to 3.
Yeah.
Business, management, and financials.
The business understanding.
Okay, let's unpack this immediate crisis, because we need to understand the catalyst. Why are we talking about this now on January 31st, 2026? What happened yesterday that has everyone so spooked?
So the catalyst hit on Friday, January 30. Rosenblatt Securities, and keep in mind, this is a firm that has historically really liked Elastic's story. They came out and cut their price target.
And it wasn't a small trim. They went from $130 down to $110.
But they kept the buy rating, right? They didn't tell people to sell.
They did keep the buy rating. And that's the nuance that the market completely, utterly ignored. The analysts kept the buy, but the reason for the price cut was explicitly multiple compression.
Multiple compression. That's one of those jargon terms we hear a lot on Wall Street. Let's, break that down for the listener who isn't a CFA. What are they actually saying?
Essentially, they aren't saying the business is broken.
Yeah.
They aren't saying Elastic is losing customers or that their software stopped working.
Right.
They are saying that investors, as a group, are just willing to pay less for every dollar of earnings. Think of it like buying a house.
Okay.
The house is the same. Same roof, same foundation, same granite countertops. But suddenly, because interest rates are up or the neighborhood is nervous, buyers are only willing to pay $400,000 instead of $500,000.
The asset didn't change. The sentiment regarding its price tag did?
Exactly. The house is fine, but the neighborhood is panicking. And specifically here, they are scared of the bigger economic picture. The report mentions the U.S. tariffs of 2025.
Right. This is the big shadow hanging over everything.
It is. We're going to get deep into the tariff mechanism in the risk section later, but the short version is imports get more expensive, hardware gets more expensive, so companies have less money to spend on software like Elastic.
And the market saw tariff risk in the note and just
Dumped it, just jumped the stock. It was a capitulation event.
And when you say dumped, you mean it.
Oh, yeah. On Thursday the 29th, the stock traded as low as $66.92. By Friday close, it was 65.93. It's investors selling first and asking questions later.
It's an emotional reaction.
Totally. It's not necessarily a logical one based on the company's own performance. It's the market screaming, I don't care about the details, just get me out.
So that's the stock price action. That's the ticker tape. But let's look at the company itself. If I'm a learner here and I just see Elastic, I might not know what they actually do. We use the analogy that it's not Google.
Right.
But if I'm a CIO at a bank, why am I writing a check to Elastic?
Think of it this way. Google is for finding a website on the public internet. Elastic is enterprise search. It is for finding a needle in a haystack of petabytes of private corporate data.
Petabytes? That's a lot of hay.
A lot of hay. Imagine a bank or a retailer like Walmart.
Yeah.
They have billions of transaction logs, customer records, application traces, security alerts. That data isn't on Google. It's locked away in their servers. Elastic is the engine that lets them query that data instantly.
So if I'm using my banking app and I search for a transaction I made 3 years ago at a coffee shop, Elastic is probably the thing finding that receipt.
That's a perfect example. Exactly. Or if you are on an e-commerce site filtering for blue shoes, size 10, under $50, Elastic is the engine returning those results in milliseconds. It's built for speed and massive scale. It handles the messy, unstructured data that traditional databases just search. They choke on it.
And this is all built on what they call the ELK stack, right? I see that acronym everywhere in developer forums.
Correct. ELK. It stands for Elasticsearch, Logstash, and Kibana.
Okay.
Elasticsearch is the database, the search engine itself. Logstash is the pipe that sucks in all the data. And Kibana is the dashboard, the visualization tool where you see the charts and graphs.
So the whole package.
The whole package. And if you talk to any developer anywhere in the world and say ELK stack, they nod. It is the open source standard for logging and search. It's ubiquitous.
It's like Kleenex.
It's like saying Kleenex for tissues. You don't say pass me a facial tissue, you say pass me a Kleenex. Developers don't say log search, they say put it in ELK.
Okay, so they have this foundation, but the report highlights 3 specific pillars. The franchise, as Buffett might call it. It's not just search anymore.
No, it's much bigger now.
Let's walk through those. The first one is search, but they're calling it the context engine now. This sounds like a rebrand for the AI era.
It is, but it's a substantive one. This is their pivot to the AI era. We all know about large language models, LLMs, right? Like the models powering ChatGPT.
Sure, they're the shiny new toy everyone is obsessed with.
Well, those models are incredibly smart, but they have a fatal flaw for businesses. They are generic.
They don't know my company's secrets.
They don't know your company's private secrets. They don't know your customer history. If you ask a generic LLM about your Q3 sales data, it will hallucinate. It will just make something up.
It just makes stuff up because it was trained on the internet, not on my corporate intranet.
Precisely. It's like asking a stranger on the street what you had for breakfast. They can guess, but they'll be wrong.
Yeah.
So companies use a technique called RAG.
RAG. R-A-G. We're hearing that acronym a lot lately. Break it down.
Retrieval Augmented Generation. It sounds fancy, but it's actually simple logic. Before you let the AI answer a question, you first use Elastic to search your private data for the relevant facts, the context.
Ah.
Then you hand those facts to the AI and say, use this specific information to answer the question. Elastic provides the context. The AI provides the language.
So Elastic is the bridge. It connects the generic AI brain to the company's actual private knowledge base.
That's the perfect way to visualize it. And in January 2026, just this month, they launched the Elastic AI Assistant and Agent Builder.
So they're leaning in.
They are doubling down on this.
Yeah.
They want to be the standard way that corporate AI accesses data. They don't want to build the brain. They want to be the memory.
Which seems like a much safer and cheaper bet than trying to compete with OpenAI or Google on building the models themselves.
Oh, absolutely.
Okay, that's pillar 1. Pillar 2 is observability. They call this the check engine light.
Right. Imagine you run a massive streaming service like Netflix. You have thousands of servers. If the video starts buffering for users in Brazil, you need to know why immediately.
And fast.
Is it a database locking up? Is it a bad code deployment? Is it a fiber line cut? You have to know now.
And doing that manually is impossible.
Impossible. You have millions of events per second. Elastic Observability ingests all those logs, every error message, every server heartbeat, and visualizes it. It tells engineers exactly where the problem is so they can fix it before users churn.
Now, they compete with big names here. Datadog, Splunk. It's a crowded market.
It's very crowded. And Splunk is part of Cisco now.
Right. Cisco bought them for a massive premium.
They did. But Elastic's pitch is consolidation. They asked the CIO. Why pay Datadogs a fortune for observability when all your data is already sitting in Elasticsearch anyway? Just use us for that too.
Bundle it and save.
It's a compelling argument when budgets are tight.
Makes sense. And pillar 3 is security, the digital moat.
It's the same logic as observability. If you are already collecting all the logs from every server to check for crashes, you can also scan those same logs for hackers.
So it's using the same data for a different purpose.
Exactly. You can see if someone is trying to log in from a strange IP address, or if a user is downloading gigabytes of data at 3 a.m. They compete with CrowdStrike and Microsoft Sentinel here. They act as a SIEM.
SIEM.
Security Information and Event Management. It allows a security team to hunt for threats across the entire enterprise. It's like having a security camera system that watches every digital door and window.
So it's one platform, 3 massive use cases. Search, observability, security. It seems incredibly sticky.
Very sticky.
But there's been a shift in how they make money from all this. We're moving from licenses to consumption.
This is the business model shift that Wall Street usually loves, but it introduces volatility. Historically, you bought a license, you paid $100,000 up front, whether you use the software once or 1,000,000 times. Now, they are moving to Elastic Cloud. It's consumption-based, like your electric bill. You pay for what you use.
And the numbers on this are pretty stark, aren't they?
They are. Elastic Cloud is now generating $688 million in revenue. That's 46% of their total revenue.
Wow.
And it's growing at 26% year over year. This is vital because it aligns their revenue with the growth of data. As the world creates more data, which is a guarantee, companies consume more Elastic credits.
But here is where we get into the bear case, the argument against them. We have to talk about vector databases. I keep hearing about Pinecone. It was the darling of 2024. Is Pinecone killing Elastic?
This is the hype cycle of 2024 and 2025 speaking. Everyone got excited about vector search. This is searching by meaning rather than keywords.
Can you give us a concrete example? What's the difference between a keyword search and a vector search?
Sure. In a traditional keyword search, if I type Apple, the search engine looks for the letters A-P-P-L-E. It might give me a fruit or it might give me the iPhone company. It doesn't know the difference.
It just matches text.
It just matches strings of text. Vector search converts words into numbers, vectors that represent meaning. It understands that Apple is close to iPhone and far away from banana, depending on the context. It captures the intent of the search.
Okay, so that sounds better. Why is that a threat to Elastic?
The fear was that specialized databases like Pinecone, which only do vector search and do it very fast, would replace Elastic. Investors thought Elastic was a dinosaur. But the reality in 2026 is that vector search alone isn't enough.
How so?
It lacks precision. Sometimes you do just want to find the exact document with the invoice number 12345. Vector search is terrible at that because 12345 has no meaning in the semantic sense.
It's just a string.
It's just a string. If you use vector search for that, you get weird, fuzzy results.
Ah, so you need both. You need the vibe search and the exact search.
Exactly. You need hybrid search.
Yep.
You need the old school keyword precision, which uses an algorithm called BM25, combined with the new school vector understanding, which uses K and N.
And Elastic does both?
Elastic offers both in one box. Pinecone generally doesn't offer the same level of keyword sophistication, and Elastic argues they are the leader in hybrid search.
Plus, there's the concept of data gravity. I love that term.
This is huge. If you are a massive bank, you have petabytes of data already sitting in Elastic. Are you really going to move all of that to a niche startup like Pinecone just to get a slightly different vector search?
Probably not. Sounds like a nightmare project.
Probably not. It's hard to move that much data. It's risky. That stickiness is proven by their net expansion rate, which is around 112%.
That means existing customers are spending 12% more every year.
Yes. They aren't leaving, they're digging in. They are expanding their usage.
Before we leave the business section, there's one more trending topic. Serverless. They just launched this on AWS in January 2026. Why does this matter? Is it just a buzzword?
It fixes their biggest weakness: complexity. Historically, running an Elastic cluster was hard work. You had to be a specialized engineer. You had to manage the hardware, the storage, the upgrades, the sharding.
A lot of overhead.
A ton. Serverless separates the storage from the compute. I mean, you can just click a button and scale. You don't have to be a wizard to run it anymore. This lowers the barrier to entry significantly.
So it helps them compete with the cloud-native guys?
Exactly. The guys like Datadog who've been easier to use for years.
So good products, sticky ecosystem addressing the complexity issues. But a product is only as good as the people running it. Let's look at the leadership.
Management evaluation.
We have two key figures here, the CEO, Ashutosh Kulkarni, and the founder CTO, Shay Banim. Let's start with Kulkarni. He took over in 2022. What's his report card looking like?
He's been the adult in the room in the best possible way. He came in with a mandate to shift from growth at any cost, which was the vibe in 2021, to profitable growth.
A very different environment.
A completely different world. And he's had to do that while interest rates were skyrocketing from 2023 to 2025. That is a very difficult tightrope to walk.
It hasn't been smooth sailing, though, right? There were some bumps.
No, it hasn't. In early FY 2025, they had some execution hiccups. They did a sales reorganization that went wrong, confusing territories, reps not knowing who to call, and they had to cut guidance. That hurt their credibility.
Sure.
But, and this is key, he recovered. By Q1 and Q2 of FY 2026, they were back to beating guidance. He showed operational resilience. He fixed the mistake.
And strategically.
Strategically, he's been very clear. He avoided the temptation to build his own LLM, which would have been a money pit.
Right.
He said, no, we are the context layer.
Right.
That was the right call. It saved them billions in R&D that would have been wasted fighting Google. He's pragmatic.
And then we have Shay Banim, the founder. He's still there as CTO.
This is founder mode. Having the technical visionary still control the product roadmap is massive.
Why is that so important?
It prevents the company from becoming just a sales organization. It keeps the developer culture alive. He's the one ensuring the engineering talent doesn't get hollowed out. When you have the guy who wrote the original code still in the building, the engineers know they are respected. It helps retention.
Now let's talk about something that really matters to investors. Capital allocation. What are they doing with their cash? Because talk is cheap, but writing a check is real.
This is the strongest signal we have. In October 2025, they authorized a $500 million share repurchase program.
Buybacks.
Yes, and they aren't just talking about it. In Q2, FY 2026, they bought back 1.4 million shares. They spent $114 million of actual cash.
Okay.
But listen to the price point. This is the detail that matters.
What was the average price they paid?
$84.45.
$84.45. And today we are sitting at $65.93.
Exactly. If the management team and the board thought the stock was good value at 84, they must be salivating at 66.
You'd think so.
They've explicitly stated they plan to use 50% of their free cash flow for buybacks. That is a disciplined, shareholder-friendly strategy. It puts a floor under the stock, theoretically.
However, we have to look at the other side of the coin, insider selling. The CEO sold stock recently. We can't ignore that.
He did. Kulkarni sold about $1.5 million worth in December 2025 at around $75.
And others too.
The CFO and CRO also sold chunks. Now, usually this is for taxes on their equity compensation, RSUs, restricted stock units, fairly standard.
But optically.
Optically, it looks bad when the stock is falling. It gives ammunition to the bears.
But there was one buyer, one person swimming upstream.
The lone green flag.
Oh.
Director Paul R. Oval III. On December 1st, 2025, he went into the open market. This wasn't an option exercise. This wasn't a grant.
This is his own money.
He took his own money and bought 10,000 shares.
At what price?
$71.02. That's a $710,000 bet.
So a director is buying at 71, the company is buying at 84, and the market is panic selling at 66.
It is. Interesting.
It's a divergence.
It is. And value investors live for divergences. It suggests that the people inside the boardroom, seeing the real data, value the company much higher than the panic sellers on the street.
Let's check the health of the patient. Are they actually making money?
Financial health.
Let's run the numbers. Revenue, are they growing?
In FY 2025, they did $1.483 billion, up 17%. For FY 2026, the guidance is around $1.68 billion.
Okay, so that's a growth rate of about 14 to 15%.
That's right.
So 17% dropping to 14. That deceleration is part of why the stock is down, right? The market hates slowing growth.
It is. The multiple compression we talked about happens when growth slows. Investors pay less for slower growth, but the quality of that revenue is higher because of the consumption model.
It's not empty calorie.
Exactly. It represents actual usage.
What about margins? Is this a profitable business, or does it cost them $1 to make 90 cents?
The gross margin is elite. It's between 74 and 76%.
Wow.
That is software monopoly territory. It costs them almost nothing to serve the next customer. That is a beautiful thing. It means that as they grow, most of that new revenue flows down to the bottom line. It's a very scalable business model.
An operating margin.
Non-GAAP operating margin expanded to 16.5% in Q2 FY 2026. They're getting more efficient. They're managing costs well.
But I have to play devil's advocate here. You said non-GAAP. That's the adjusted number. What about the real number? The GAAP number?
The elephant in the room, GAAP operating margin is still negative. It's minus 2%.
Why? Why the difference?
Stock-based compensation, SBC. They pay their engineers in stock.
Right.
In the non-GAAP numbers, they pretend that the expense doesn't exist. In GAAP, they count it. So technically, on an accounting basis, they are losing money.
And critics will jump on that.
And critics will say, hey, stock is real dilution. You can't just ignore it. And they are right. It is a real cost to shareholders.
But are they burning cash? Are they in danger of running out of money?
No.
Yeah.
And this is the bull case engine. Free cash flow is exploding.
Okay.
In FY 2024, they generated $145 million. In FY 2025, it jumped to $262 million. That's an 80% increase.
So the bank account is growing even if the accounting profit shows a loss due to stock grants.
Exactly. And for valuation, cash flow is king. You can't fake cash. They're currently at a rule of 40 score of about 35.
Remind us what the rule of 40 is.
It's a metric for software companies. You add your growth rate, which is 16%, to your profit margin, which is 19%. If the number's over 40, you're elite.
Those are close.
Elastic is at 35. They aren't elite yet, but they are close. They want to get back to 40. If they do, the stock usually re-rates higher.
And the balance sheet, is it safe?
It's a fortress. As of October 34, 2025, they had $1.396 billion in cash.
Wow.
They have a net cash position. So even with high interest rates, they aren't drowning in debt. They have a massive buffer. They can weather a storm.
Which is good because it feels like a storm is here.
Chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Market sentiment.
We've established the business is real, the cash flow is growing, and management is buying.
So why does the market hate this stock right now? What is the current mood?
The mood is washed out. It feels like everyone who wanted to sell has sold. There's a sense of exhaustion. It's like the stock has been beaten down so much that there's no one left to sell it.
Let's look at the analysts, the people whose job it is to rate this stuff. What are they saying?
It's a fascinating disconnect. The consensus is still a moderate buy. We have 17 buys, 11 holds, and only one sell.
One sell. Okay.
And the average price target is $105.
105, but the stock is at 66. That's nearly 60% upside.
It's huge. And even the lowest target on the street, the most pessimistic bear, is $75. So even the biggest bear thinks there's upside.
That's still 14% upside from here. So even the person who likes the stock the least thinks it is too cheap right now. That sets a very interesting psychological floor.
So why are they cutting targets? Barclays went to 100, Jefferies to 95. Why lower the target if the upside is so big?
They are chasing price. The stock drops, so they lower their target to look smart and align with reality, but they don't flip to a sell rating. It tells you they view this as a macro problem, the tariffs, the economy, not a structural problem with Elastic. They are scared, but they aren't leaving. They're hedging.
They don't want to look foolish having a 130 target on a $60 stock.
But they also don't want to miss the rebound. Exactly.
What about the short sellers? Is there a big bet against the company? Are the sharks circling?
Surprisingly, no. Short interest is only about 4.1% of the float. That is very low for a tech stock that is down this much.
What does that tell us?
It tells us this isn't a short attack. The price drop isn't because hedge funds think the company is a fraud or broken.
Right.
If they thought the books were cooked or the product was obsolete, short interest would be 15 or 20%. It's driven by long-only funds, mutual funds, ETFs, just liquidating. They are selling because they are tired of waiting.
Tired of waiting for what?
The AI boom. This is AI fatigue. Investors look at NVIDIA and see explosive growth. Then they look at Elastic. Elastic is an AI play, but it's infrastructure.
It's slower. It's boring.
It's slower and it's boring. And investors are punishing boring, profitable growth because they want hype growth. They want the lottery ticket, not the savings bond. They see Elastic trundling along at 15% growth and they say too slow and they dump it to buy more NVIDIA.
So it's an impatience penalty.
Exactly.
Ownership structure.
Let's talk about who is holding the opportunity right now, the ownership structure. It seems like a battleground between different philosophies.
It really is.
Yeah.
It's long-term versus momentum. You know, the giants, Vanguard, BlackRock, State Street, they hold the passive base. They aren't selling. They just track the index.
They're the bedrock.
They're the bedrock. They hold about 30 to 40% of the stock, regardless of what happens.
But who is selling? Who is causing this price drop?
The active managers, specifically Baillie Gifford. They are a famous Scottish growth firm, famous for early bets on Tesla and Amazon. They have been trimming their exposure.
They're growth hunters.
They're growth hunters, and Elastic isn't growing fast enough for them anymore. They are looking for the next hyper-growth rocket ship. When a big whale like that sells, it creates consistent downward pressure.
But as they leave, someone else is entering a rotation.
Yes. Pictet Asset Management. They filed a 13G in January 2026.
Who are they?
A very conservative, long-term European asset manager. They are value-focused. The fact that a conservative European firm is stepping in right as the aggressive growth guys are stepping out is a classic rotation.
The baton is being passed.
The baton is being passed from the speculators to the investors. It's validation that the valuation has become attractive to value investors, not just growth chasers.
And we can't forget Shay Bannon, the founder.
He holds over 6.4 million shares. He has voting control. This is important because it means a hostile takeover is unlikely.
Right.
But it also means he is fully aligned with shareholders. If the stock tanks, he loses a fortune. He has the most skin in the game. He's not just an employee. His legacy and his net worth are tied to this stock recovering.
Risk assessment.
We have painted a pretty rosy picture of the internals, but we have to address the elephant in the room. The reason the stock dropped 39%. The risks. Let's talk about the tariffs of 2025.
This is the Rosenblatt risk. This is what spooked the market on Friday. It's not about Elastic directly, it's about their customers' wallets.
Walk us through the mechanism. How does a tax on imports hurt a software company that doesn't really import physical goods?
It's second-order effects. The U.S. administration put 10 to 20% tariffs on imports, specifically targeting electronics and transformers.
Okay, so hardware gets more expensive.
Right. Elastic's customers are CIOs, chief information officers. They have a fixed budget for the year. They need to buy servers, GPUs, and hardware to run their data centers.
And because of the tariffs, that hardware now costs 20% more.
Exactly.
I see where this is going.
It's the crowding out effect. If the CIO has to spend more on the hardware line item, they have less money left over for the software line item.
They rob Peter to pay Paul.
Yes. And Elastic is Paul. They might delay expanding their Elastic subscription. They might say, we'll make do with what we have for another 6 months. They can't delay buying the hardware if they need the capacity, but they can delay the software upgrade.
So the fear isn't that Elastic is bad, it's that the customers simply run out of money.
Correct. That is the macro fear. And in a recessionary environment, software expansion is often the easiest thing to cut or delay.
What about the competitive risk? We touched on it with Pinecone, but let's broaden it. The squeeze.
Elastic is getting squeezed from both ends. On the low end, you have AWS OpenSearch.
Right, the Amazon version.
It's a forked version of Elasticsearch. It's commoditized. It's cheap. If you just want basic search, AWS says, why pay Elastic? Use ours. It's integrated right into your AWS bill.
And on the high end,
You have the specialized tools like Pinecone for AI. So the risk is that Elastic loses the cheap customers to AWS and the fancy customers to Pinecone, leaving them with nothing in the middle.
the mushy middle.
The mushy middle is the worst place to be in tech.
What is their defense? How do they avoid being the mushy middle?
Integration. Most
Wow.
companies don't want 5 different databases. They don't want a database zoo. They want one platform that does it all well enough.
The Swiss Army knife.
Exactly. And again, data gravity. Moving data is painful. That pain is Elastic's best friend. They are betting that good enough at everything beats perfect at one thing. It might not be the best scissors in the world or the best knife in the world, but it's the one you have in your pocket.
Let's do a quick SWOT recap before we hit the conclusion.
Sure. Strength. A sticky ecosystem. Once you're in, you stay. High switching costs.
Weakness.
Complexity. The ELK stack has a steep learning curve compared to Modern, slick tools,
Opportunity.
generative AI and RAG, becoming the corporate brain.
And the big one, threat.
Commoditization by AWS and the tariff-induced recession squeezing budgets.
Conclusion.
Okay, we've looked at the good, the bad, and the ugly. It's time to land the plane. Let's do some scenario planning. What is the bear case? What happens if it all goes wrong?
The bear case is that the squeeze works. AWS takes the low end, Pinecone takes the high end, and the tariffs crush IT budgets so no one expands.
Growth stops.
Growth stops completely. The stock derates to maybe 3 times sales. In that nightmare scenario, the stock goes to $45 or $50.
So another $15 to $20 drop.
Yes. It's painful, but maybe not a zero. It's unlikely to go bankrupt with that much cash, but it could be dead money for years.
And the bull case.
The bull case is that Elastic wins the AI infrastructure war. RAG becomes huge. Companies realize they need hybrid search and that Pinecone is a toy. Margins hit 20%.
And the stock.
The stock re-rates to a premium software multiple, say 8 to 10 times sales. Then you're looking at $120 plus, a double from here.
But let's look at the deep value calculation, the intrinsic value. You ran a DCF discounted cash flow. Walk us through the assumptions.
We tried to be conservative. We didn't assume rainbows and unicorns. We assumed revenue growth of only 14%, so no massive reacceleration. We used a high discount rate of 10.5% to account for the risk. And we assumed a terminal multiple of 18 times free cash flow, which is standard for a mature software company like Adobe or Oracle.
And what number did the math spit out?
The intrinsic value came out to approximately $101 per share.
101.
And the stock is trading at $65.93.
That is a massive gap.
It's about a 35% discount. In investing terms, that is a huge margin of safety. You are buying $1 for 65 cents.
So the final verdict?
Elastic checks the Buffett boxes. Is the business understandable? Yes. Does it have a durable moat? Yes. Data gravity? Is management capable? Yes. And they are buying back stock. Is there a margin of safety? Yes, 35%.
So this is a dislocation.
The drop we saw this week is a dislocation. It's caused by macro fear about tariffs, not by the business failing. For a patient investor, this looks like an entry point.
It's the classic contrarian play, being greedy when others are fearful.
Exactly. It takes a strong stomach, but the math supports it.
So I'll leave you with this thought. Director Paul Oval is buying at $71. The company itself is buying back huge amounts at $84. The stock is sitting at $66. What does the market know that the insiders don't? Or is the market just panicking while the insiders are quietly loading up? That is for you to decide.
Indeed.
As always, thank you for listening to this deep dive. A quick reminder, this analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.
See you next time.